Welcome to Iron Financial, where we forge stronger portfolios and cut through market weakness. Today, we are putting a Rust Belt utility company under the microscope, DTE Energy. Now, they're attempting a massive pivot, a really high-stakes, multi-billion-dollar bet to become the power source for the entire AI revolution. And the market has definitely noticed. This is not some undiscovered stock we're just unearthing from the bargain bin. No, the stock is already running hot. And the numbers? Well, the numbers are telling two completely different stories. So our job today is to figure out if this is a solid steel foundation for future growth, or if it's a structure that's about to collapse under the sheer weight of its own ambition. Let's get into it.
Okay, let's frame the core conflict right here on the table. You've got a legacy utility, DTE, which for, 100 years has been the absolute definition of a slow, steady, predictable dividend payer. Now, all of a sudden, it's at the epicenter of the biggest technological shift of our generation, artificial intelligence. But that stock chart, it tells a story of its own, doesn't it? A 15.7% one-year total return for a utility company is a massive move. So the question every single investor has to ask themselves is brutally simple. Are we late to the party? Or even worse, is the party already over and we're just being asked to pay the cover charge for an after-party that might not even happen? We're here to figure out if there's any structural integrity left in this trade, or if we're just looking at a fresh coat of hype on a very, very old building.
All right, let's drill down into the core thesis here. Because to really understand the opportunity for a company like DTE, you have to understand the fundamental mechanics of the AI boom. Look, this is not just about silicon chips and some elegant algorithms. At its core, it's about raw, brute force electrical power.
And this is the one part of the story that is absolutely undeniably real. We are talking about an energy demand that is completely unprecedented. It's almost insatiable. These new data centers, these large language models, they are energy hogs on a scale we have never seen before in our lives. So you can forget about trying to pick the winning AI software company. The durable gold rush might be for the companies selling the picks and shovels, or in this case, the gigawatts. Exactly. And that is where DTE, a Michigan-based utility, just made a move that puts it squarely in the major leagues of this new energy arms race. They've effectively gone from being a regional power provider to a key potential builder of the infrastructure for this entire new digital age. The narrative, you have to admit, is incredibly powerful. Now, let's see if the numbers can actually carry that weight.
Okay, now we get to the bull case. Let's set the story aside for just a minute and get into the engine room. I want to look at the hard data, the numbers that are making Wall Street so optimistic, the figures that are painting a picture of explosive, almost non-utility-like growth just on the horizon.
So this is the first load-bearing number we have to look at, $7.36. That was DTE's operating earnings per share for 2025. Now, why does this matter? Well, because their own guidance, their own forecast, topped out at $7.23. So they didn't just meet expectations, they solidly beat the high end of their own range. This tells you that management is executing right now, demonstrating some core operational strength before these massive new projects even begin. A solid beat, I'll give you that. But a single year of strong performance doesn't build a fortress. That's one good quarter in what's going to be a long, very expensive war they're about to fight. We need to see what's fueling the future, because past performance, as they always say, is no guarantee of future results. What's the real catalyst here?
Here is your catalyst, 1.4 gigawatts. This is the landmark 19-year agreement DTE signed with Oracle to power their new data center. Let's just try to put this number in perspective for a second. 1 gigawatt is enough to power roughly 750,000 homes. This single deal represents a massive, guaranteed, long-term new source of demand. This isn't speculative, it is contracted revenue from a blue-chip tech giant. Okay, it's a huge headline number, there's no doubt about it. But big deals with tech giants like this are a double-edged sword. To land a marquee name like Oracle, did they have to give away the farm on pricing? I mean, the source material says Oracle's revenues will cover the costs, which is just table stakes. That's the bare minimum. But what are the margins? Is this a high-profit project, or is it a low-margin volume play that's really just designed to generate a flashy press release and goose the stock price? That detail is absolutely crucial, and it's missing.
And this is how they plan to meet that demand. $36.5 billion. That is their new 5-year capital investment plan for 2026 through 2030. This is a colossal increase from their prior plan, and it's almost entirely driven by the needs of the Oracle deal and the broader grid modernization that's required to handle this new era of power demand. They are not just patching the system, they are rebuilding it from the ground up. $36.5 billion. That is an astronomical sum of money for a company with a market cap that hovers around $30 billion. This isn't a growth plan. This is a bet the company move. They are literally rebuilding the entire company while it's still running. The execution risk here is completely off the charts. A project of this scale is just begging for cost overruns, regulatory headaches, construction delays, you name it. This isn't a number to celebrate, it's a number to be deeply, deeply cautious about.
And here is the payoff for taking on that massive risk. Management is guiding for 6 to 8% annual operating EPS growth all the way out through 2030. Now, for a utility, that is an incredibly strong and confident forecast. Most utilities, they dream of 3 to 4% growth. DTE is projecting growth you would expect from a tech company, and they've explicitly stated they are confident they will reach the high end of that range, which is 8%. That 8% growth target isn't a forecast, it's a prayer. It is entirely dependent on flawlessly executing that $36.5 billion plan with zero room for error. It assumes regulators are going to play nice, construction stays perfectly on schedule, interest rates don't move an inch, and commodity prices behave. That's a whole lot of faith to put into a 5-year construction forecast. To me, that doesn't sound like an investment thesis, it sounds like a fantasy.
But the bull case doesn't even stop with Oracle. This is what's in the pipeline. They're already in late-stage negotiations for another 3 gigawatts of data center load. Now, if they land that, it would more than triple the size of the Oracle deal. If that comes through, the growth story gets another massive injection of fuel. You also have potential upside from renewable natural gas tax credits, which management has signaled will help them hit the high end of their growth targets. And I see they've highlighted their dividend history. Over 100 years. That's the old DTE, the stable, predictable, boring utility we all knew. The real question is, can that coexist with the new DTE, the high-growth, high-risk, high-capex developer? You can't be a safe utility and a high-risk construction company at the same time. Something has to give. And if those multi-billion-dollar projects hit a snag, you know the first thing on the chopping block is usually the dividend check.
And this quote from the CEO, Joni Harris, it perfectly caps the bull case. Management is confident. They're framing this not just as a win for shareholders, but as a long-term benefit for their entire customer base. They argue that by bringing on a massive new customer like Oracle, they can spread the fixed costs of the grid across a larger base, which could ultimately lead to affordability benefits for residential customers. It's a compelling narrative, growth that also serves the public good. It is a great story. And look, if they pull it off, it's a grand slam home run. But our job isn't to believe the story, it's to stress test the foundation. And that's where things get complicated. Let's look at the other side of the ledger.
All right, now for my side of the analysis. We've heard the growth story, and I'll admit it is intoxicating. But a skyscraper is only as strong as its foundation. We need to dig into the balance sheet and the core financials to see if DTE actually has the structural strength to support this massive, ambitious build-out. It's time to go looking for the cracks.
Let's start with valuation. Look at this PE ratio. The bulls will point right to that middle column and say, see, at 21.8 times earnings, it's cheaper than its direct peers at 23.6x. But that to me is a dangerously narrow view. It's the most relevant comparison though. You have to compare a company to its closest competitors, the other utilities that are also trying to capture the same AI-driven growth. I disagree. That's like comparing 2 overpriced sports cars and declaring one a bargain just because it's slightly less expensive. Let's look at the whole dealership. The broader utilities group on the right, the reliable family sedans of the market, they trade at 19.7x earnings. DTE is significantly more expensive than them. The market is already pricing it at a premium for a growth story that hasn't even been delivered yet.
So this really is the crucial question, isn't it? The market just can't decide what DTE is. If you view it as a high-growth infrastructure play that's powering the entire AI revolution, then a PE of 21.8x might seem reasonable, maybe even cheap compared to what's coming down the pipe. But if you view it as a highly leveraged utility with a negative revenue trend that is taking on a mountain of construction risk, then 21.8x looks dangerously expensive. The price is stretched taut between these two narratives. And before we try to answer that, let's dig deeper into the balance sheet, because this is where the real red flags are flying.
Here are the cracks in the armor. First, that 3-year revenue growth, negative 7.9%. A growth stock with a shrinking top line? That is a fundamental contradiction. That's not a backward-looking metric. That's a hole in the ship's hull that they're promising to patch with future money. The ship is taking on water now. Second, the debt-to-equity ratio, 2.08. That is heavy. For a company that's about to take on a $36.5 billion capital plan, it's borderline reckless.
Every single basis point that interest rates rise is another stress fracture in this company's foundation. And finally, the insiders. The people who see the real blueprints and the real budget reports every single day, 0 buys, 4 sells. The people with the most information are quietly heading for the exits. That should tell you everything you need to know. You're focused on the rearview mirror. The negative revenue is a historical artifact from before the AI catalyst kicks in. The debt is necessary leverage to capture a once-in-a-generation opportunity. You can't build a skyscraper without a construction loan. And insider selling happens for dozens of personal reasons. You're analyzing the old DTE, while the market is looking forward to the new DTE that will power our entire digital future.
Okay, I want to introduce a specific financial metric here, because it's a serious one that investors really need to understand, the Altman Z-Score. It's a formula that was developed decades ago, and it combines 5 common business ratios to estimate the probability of a company going bankrupt. Think of it as a financial stress test for a building's foundation. And as you can see from the definition right there, any score below 1.8 is considered the distress zone. It's a serious warning light on the dashboard. And DTE score is 1.05. Let me repeat that, 1.05. This isn't just in the distress zone, it's deep in the distress zone. Now, am I saying DTE is going bankrupt tomorrow? No, of course not. Regulated utilities have certain protections. But what this number screams is that the company has a very, very weak financial foundation. This isn't just a red flag, it's a 5-alarm fire on the balance sheet. And this is the foundation upon which they want to build a $36.5 billion project. The math just doesn't work. It's an undeniably low score, I'll grant you that. The counter-argument is that the Z-score is based on historical data and it doesn't account for the guaranteed long-term revenue stream from the Oracle contract, which you could argue fundamentally de-risks their future cash flows. But the number is what it is, and it absolutely highlights the extreme leverage the company is operating under. This entire plan is a high-wire act.
So what we have here are 2 completely opposing forces. On one hand, you have an undeniable explosive growth catalyst that's tied to AI. On the other hand, you have a balance sheet that shows significant signs of stress and financial distress. Let's try to synthesize these 2 competing narratives and see where that leaves us on the valuation.
Here it is, side by side. The growth narrative on the left argues that the analyst consensus price target of around $147 is fair, and it's justified by that massive capital plan, the AI demand, and that powerful 6 to 8% EPS growth forecast. This narrative sees DTE transforming into something much more valuable than just a simple utility, and the valuation reality is right there on the right. It says the stock is already expensive, the PE ratio is high, the price-to-book ratio is near a 3-year peak, and the technicals, like the RSI at 75, suggest the stock is wildly overbought. This narrative says the market is already priced in the absolute best-case scenario and completely ignored the underlying financial risks. You're paying for the penthouse view before the foundation is even poured.
And this just reinforces my point. Look at the run this stock has had. Over 15% in a single year for a utility. The market has been rewarding DTE for telling a good story. This is not a ground floor opportunity. The easy money, in my opinion, has already been made. But you see past performance, I see momentum. I see the market waking up to reality. Smart money is rotating in, recognizing that DTE is no longer just a utility, but a critical piece of AI infrastructure. The question for new investors isn't what the stock has done, but what it's going to do when that next 3-gigawatt deal gets announced.
Okay, let's bring all this together. We've examined the growth engine. We've stress-tested the financial foundation as best we can. It's time to forge a final verdict. What is the core investment thesis here, and what is the ultimate trade-off that an investor is making?
Let's walk through this step by step. 1. The opportunity. The AI power demand is real and it is massive. This is not hype. 2. The transformation. DTE is actively trying to become the solution to that opportunity. They are pivoting from being a dividend stock to a growth stock. And 3. The risk. This is the part that gives me pause. That transformation is being built on a highly leveraged foundation, as shown by that Altman Z-Score. They are taking on a colossal construction project with a balance sheet that is already strained. And 4, the price. The market sees the opportunity and has already bid the stock up significantly. This is no longer a value play. It's a bet on flawless execution.
So, this is our final verdict. DTE is not a simple buy or sell. It's an investment in a high-stakes transformation. They are essentially attempting to bolt a rocket engine on a reliable but very slow station wagon, and hoping the chassis doesn't rip apart at liftoff. If they succeed, the returns could be absolutely incredible. But if they stumble, if projects face delays, if interest rates spike, if regulators push back, that weak foundation could crack under the pressure. The risk is just as real as the opportunity.
And that leaves us with the final critical question that every investor needs to answer for themselves. We've established the demand for AI power as an undeniable force. DTE has stepped up with an ambitious, maybe even audacious plan to meet it. The question for your portfolio is one of structural engineering. Can this company actually bear the weight of its own ambition? Can they execute the largest construction project in their entire history without letting their debt-laden balance sheet crumble beneath them? That is the $36.5 billion question you have to answer before you invest. Thanks for joining us on Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.